forgot to put this at the beginning, but we're still posting the watch list tonight. But usually when I post 2 videos in a day, it doesn't come up right away. So make sure you guys have the bell or just check around 6 p.m. Pacific time, maybe 6:30 for the watch list so you don't miss it. But here you go. What's going on, ladies and gentlemen? I hope you're having a wonderful day. We started the long-term investment account. I did this on YouTube, created a brand new long-term portfolio to show you this. We talked about it a lot. It's pretty interesting. We started this 1 week ago and seeing what's going on with it, but we were talking a lot about dividends and how it's working. And one thing that I think is really, really important is a dividend reinvestment plan, DRIP. There's 2 things we'll talk about with this, but I thought I'd drop this for you guys so you could quickly, easily learn how to do this, because I had trouble setting this up with TD Ameritrade. They said you needed to call in and do all this, but actually you could do it all online. But if you Googled it, it would send you all through this. So I just want to show you guys what this is, talk about it briefly, and give you like a 1 week update and kind of what to watch and recap. And if you guys haven't seen the long-term investing video, it's in the description below. So make sure you check that out and follow along. We're trading live Monday through Friday, 30 minutes before open. So hopefully we see you there, but we've been doing all this and this is going to be fun. But it's quite simple. You log into here to set up the DRIP, and you go down to dividend reinvestment, then it says all this convenient way, then you go to stock and ETF dividends, click enroll and edit, and as you see here, mine says dividends reinvested. So what you want to go here is edit enrollments to turn this on, and then you could enroll all current, and that's what I did. But then I also saw this automatically enroll all current and future eligible stocks and ETFs in DRIPs. And now the cool thing is I read the terms and conditions. They will even allocate fractional shares, believe it or not. I know a lot of people are interested in like M1 Finance and stuff like that with fractional shares. I'm not too big of a fan, but I kind of like it through TD Ameritrade because, again, I think they'll eventually give you a full share and how it turns. There is, subject to terms and conditions, option trading, extremely risky. You can lose off that much your financial investment. Please consult with the financial advisor. It's for educational purposes only. But still, this is something good to have. So I would suggest you all do this with your long-term portfolio, even though this is not a recommendation. This is just what I'm doing. But the DRIP is very, very crucial for long-term investing. So now if you don't know what it is a dividend reinvestment plan. So now you guys could see here are the first 5 stocks we picked. Clearly, Snap and Spotify don't have dividends, but Altria, IRM, and AT&T do. So if these are paying out $244 a year per share, in this case at least, what it's going to do now is every 3 months or the payout schedule to when they pay the dividend, it's going to take your dividend and instead of just giving you a cash payment for it, it's going to reinvest that into a stock. And now this is what we want for compounding growth and interest. Now, you could do this with any brokerage besides TD Ameritrade. So understand if you are trying to build a long-term investing portfolio, what you could do with DRIP is way better than just keeping the cash. So I pulled up a nice little calculator to show you again. This is just literally making random assumptions here, and I'm trying to keep it conservative. So let's say we're starting with like $100 in the IRM, and let's say it's saying your monthly contribution. If you added, $200, or let's say we added even $50 a month to that stock, right? Then the current price of the stock at 100, it's expected to go up 3% a year. Now, that is not the strategy we're employing. If you guys see, and I'll highlight what the plays we've made to kind of go over our long-term plan, give you a quick summary, but we're going for more growth. But I want to be conservative here. I'd rather show you a small number than not. Let's say after 10 years, current dividend yield is 7.4. Expected dividend growth rate is 1%. Well, actually, I wanted to double check that to kind of make it. So IRM, it's actually a 16% dividend growth rate. So I guess, let's say we'll put it right in the middle. We'll say like 8% dividend growth rate, because that was its rate over the last 5 years. So here's without DRIP, and then it says it's taxable as well, but calculate the return. So literally in 10 years, and now I know this may not sound like much, but again, if you're allocating your money and keeping it small, and again, just keeping it very, very simple, and this is assuming the stock only grows at 3% a year, but after 10 years, you'll have $6,200, and then you'll have 47 shares. Now, what happens if we do a dividend reinvestment plan? This is the DRIP, calculate the return. So 100 is 6,000 without DRIP. With DRIP, you're getting 8,500, and then you're getting, instead of 47 shares, you're getting 65, almost double. So again, if the stock ends up growing more than 3% a year, if it grows 6% a year, you're going to make slightly more money again and everything else. But at the end of the day, this is a great way to get more shares. And if there's anything that happens in the future with this split, we're going after these bigger growth companies, whatever it may be, all of this is going to be important to just hooking you up in the future and kind of setting up something. And now some of you are like, $100 into 7,000 in 10 years. I know it may not sound crazy, but the key is, you know, if you even put it into context after that, the key is to get more and more shares, because then what happens after 10 years, you'll be sitting on 60 shares of IRM. Its dividends growing. Even if the dividend stayed at $250 per share per year, you're going to start making what, like $120, $200 a year off that stock. But then you got 4 or 5 other ones plus the equity. Put your money in the right place, it could grow for you, but now you pretty much just have your own little rental property giving you income. So, and again, the point is, you know, these numbers aren't too big, especially for some of you like, I'm young, I want more. That's why we say go to growth. You know, IRM and dividend stocks are going to operate a little bit different than anything, you know, the Snapchat and Spotify. But I guess the younger you are, you know, let's put this on like a 25-year plan. Well, let's just for shits and giggles. That initial $100 and little by $50 a month, that'll turn into a pretty decent sum after 25 years. So you even see after year 10, it starts to get a little crazy. By year 15, instead of going 1 to 10,000, it actually triples from 9,000 to 21, or just under triples. But the key here is always going to be, you know, the price, where the equity goes and all that. So there's a lot to it, but regardless, hopefully you guys are getting an idea of here. And now this is how you do the drip. Nice, simple, easy. And coming back to the portfolio, you guys saw us build this, and this is what talking about the balance, just to recap, we made this. I'm doing this on YouTube, and I'm doing this to highlight the main key points here with the long-term investing. Everybody says they don't have a lot of money, that you can't invest. I'm going to do this. I'm going to day trade first, and then I'm going to invest. That's fine, but I recommend you, or no recommendations, but I say anybody could start. Anybody could start right away with even the littlest amount of money. And, you know, you're seeing what could happen on the conservative basis and these calculators and all that. But at the end of the day, if you put yourself in the right positions, you could get pleasantly surprised and pleasantly lucky, I would say. And that's what we're going for here. You know, it's not as if I'm going strictly for dividend stocks. This is one of them, and you can see how much we've put into it. We put $96 into one dividend stock, $85 into another, Altria, and they both pay, you know, these are both 7% dividend yields, but they've dropped so much that I'm going after dividend stocks that pay a high yield, that are still relatively safe, but that could also experience equity growth. And then we're weighted more. You see, you got $200 into these dividend stocks, and then now you got what, $240, almost half into 2 of these growth risky companies, pay no dividend, and then AT&T is kind of like the in-between buffer medium there. And that's kind of how I want to build this. So we're planning to add $200 a month and buy a separate set of stocks. So now even with this plan, this was saying $50 a month on that $100 stock. Let's say we did put the whole $200 in there. After 10 years, it's saying that we'd be at $36,000. So as you see, with dividends, drip, and everything, you could be pretty good off that initial, you know, we're saying $3,600 a year could turn to $36,000, or even again, after 25 years, you're looking at $412,000. And again, these are just estimates and stuff like that. But again, at the end of the day, this is how we built this portfolio. That's why it's small. That's what I'm going to be doing, adding $200 a month. You guys could follow along. And the goal with it is, you know, we're going to be putting $200 a month into the long term, $100 into the Robinhood investing. And, you know, this is the account that we've been putting the $100 a month into, but this was from the last 100. It got up to 1,100 total. But the key is it's allowing us to trade a little bit, control it, but also take advantage of the long term. And putting it into perspective, $300 a month, that's $3,600 a year. If you make $36,000 a year, this is like saving 10% of your income and putting into something like this. So even if you put it into one good dividend stock, you wanted to hold it and just, you don't have to buy all of these companies. You know, we're going for growth, but even if you did that $3,600 a year into a decent dividend with decent growth, you know, after 20 years, you'll have $500,000. I know it sounds crazy, but if you're 20 now, by the time you're 40, you'll have $500,000, or even better, if you're 40 now, what about by the time you're 60, you'll have your retirement, whatever else you got in life that you already have now, and then by then you'll have another $500,000. I mean, I'll take it. Not to mention the yields that after, you know, you've dripped for a big amount of time and you're getting bigger dividends now, what you could do is just stop your drip later and then start taking the cash as income. But that's what I recommend early on in here, is doing the drip early so you could compound with more time by reinvesting your dividends. But hopefully that helps. Hopefully it gives you guys an update. Let me know. I am going to ask you guys a few questions on this long-term portfolio, how we need to manage the Robinhood, if I should take the option profits, this. I'll make another video. We'll make it formal, but I'll hook you up with that. We still got the watch list tonight, so make sure you guys are good to go, and that's it, baby. So I'll see you guys in the morning and tonight. Wait, before I go, though, I actually almost forgot this one as well, too. Here are the plays. You guys can even see the price we bought them up. We chose these 5 stocks, and here are the price points so you guys could see kind of relative. And again, I'm going to wait. I have 3 more weeks before I can deposit the next 200, but we got these 2 growth ones. Again, we bought Snapchat, and they're going to have earnings too up here, but we got them at 14. Well, these are the price of what they're now. I got to go to the transaction history. Here it is. So, oh, wait, actually, no, we could fund it on the 7th, so that's where we funded it on the 7th, but we didn't deposit more. So, yeah, that's good. That's getting me excited. I could add more money soon. I just made the first trade a week later. But we bought Spotify at 114. And as you see, I only got 1 share, but this is one of the growth ones. We bought 2 AT&Ts at 37.63, 3 IRMs at 32.26, and 2 Altrias at 42.90, and then 9 Snapchats at 13.89. So you could see kind of the plays we got, and again, the reasoning why and how we're going to be buying them is they're playing different roles within the whole account in general. And this is what I wanted to tell you guys to watch out for. Just notice how it's growing for us. You know, we're up 5% on IRM, 6% on Altria, 6% on Snapchat, and 3% on Spotify, and then 1% on AT&T. And just notice how these moves, and this is what I want you guys, you know, as we document this day by day, notice how they're supposed to be a push and pull. You know, they're supposed to carry the weight for each other. When they all move and they all go up, that's great. But we've already seen Snapchat and Spotify have gone up and down and up and down. But just watch the push and pull and where they end up. And again, pay attention to how we're going after growth, but I'm still applying it with dividends in that sense and still want the dividends that could apply growth. But that's it. Those are the plays. Y'all can see what happens from here. Now I'm gone. I love y'all. See you on the watch list tonight.